The Federal Reserve just shut the door on rate cuts, and it's because of Trump. Even with inflation cooling and unemployment holding steady, the Fed isn't budging. Now, why exactly? It's Trump's new tariffs that are throwing a wrench into everything. Now, in this video, we're going to break down exactly what the Fed said, what Trump did, and what this means for your investments. So let's get into it. So here's the headline. The Federal Reserve will not inject more liquidity into the system, even if the job market weakens. So Fed officials say inflation risks tied to Trump's new import tariffs are just too big to ignore, and they've worked for years to bring down inflation since the 2022 peak of 7.2%, and they don't want to blow that progress. So no insurance cuts, no bailouts for the market, just a hard pause. And Bloomberg reports the Fed is keeping rates steady even as core inflation cooled to 2.8% in March, and we'll still see what it potentially holds for April. Now let's talk Trump. On April 2nd, he announced massive new import levies, including a 125% tariff recently on Chinese goods, and markets freaked out. And then in a surprise move, Trump pulled back on some of the tariffs later that week. But don't get it twisted. On average, the US tariff only fell from 27 to 24%, and that's still historically high. Fed Chair Jerome Powell said they're watching this all unfold very carefully. And in his words, we're going to need to wait and see how this plays out before we can start to make any adjustments. In other words, there's no rush. Beth Hammack of the Cleveland Fed said something that really sums it up. I would much rather wait and move in the right direction than move quickly in the wrong direction. And Neel Kashkari from the Minneapolis Fed made it even more clear. The hurdle to change the federal funds rate one way or the other has increased due to tariffs. So a quick translation, even with a weakening economy, they're not cutting rates unless things get really ugly. And they're laser focused on inflation, and they're not letting market panic sway them. If you're finding this breakdown helpful, by the way, hit that like button. It really helps push this video out to more people. And let me know in the comments, should the Fed be more aggressive with cuts, or are they doing the right thing? So anyways, what would it take for the Fed to actually cut rates? According to Nomura's Jeremy Schwartz, it's going to take widespread layoffs, sharp spikes in jobless claims, and a major rise in unemployment. And even then, maybe just one cut in December, and that's a long shot. And economist Derek Tang added that longer-term inflation expectations have been quite stable, but how long can that last with price shocks? The Fed doesn't want to repeat the post-pandemic mistake of acting too late. So what does this mean for you and me? Interest rates are likely to stay high for the rest of 2025. Tech and growth stocks may stay under pressure, and bond yields could stay elevated, making fixed income more attractive. But the biggest risk? A credibility crisis. If the Fed cuts too soon, inflation could surge again, and they know that. So don't expect cuts to save the market. Make sure you position yourself wisely. So the Fed has spoken. No stimulus, no safety net, and definitely no early cuts. Trump's tariffs have changed the game, and the Fed is holding the line. If you want updates like this, make sure you subscribe to the channel. I break down the news that moves the market without the fluff. Until next time, make sure you stay sharp and stay invested. I'll see you soon.